Thank you guys for joining us today. I am Noah Rosenblatt. That is John Walkup. We are with UrbanDigs, and you guys are going to get your Q4 sneak peek market summary. This is all about intelligence kind of information. You guys are going to get it ahead of the reports that come out. Typically, what first or second week of January? It's typically when these guys come out. So we're going to go ahead and start. As always, I don't have to say none of this is trading advice because it's not Macro Monday. But as always, if you have
No,
questions, raise your hand. There's a chat down there. John's going to keep eyes on that over there.
you say
Um,
that, and I usually do. I'll try to keep eyes on it. But we, again, of course, we welcome questions. We're going to be talking high level stuff. So if you have
I
some
love them.
really,
Real,
really
real high.
intricate, totally niche questions, send them to Noah. He loves it.
I
And
love it.
let's get going.
I absolutely love it. All right, guys, take a look at this. This is your basic table, right? We're going to go into a whole bunch of data. All right, so I didn't put everything on this table, but I'm showing you guys what we got so far. We're looking market wide. I want you guys to see what's happening over here. Median sale price is coming in at 1.137. Average sales price is coming in at 2.058. These are all closings. October, November, December. That defines Q4, right? December obviously is not done. We're giving you these numbers as of today. It's possible when the reports come out in 3 weeks, they have 3 weeks more data for December. It might be slightly different. Sometimes that happens, guys. Okay.
Yeah,
Think
and
about,
and I want to
yeah,
throw in one more caveat, which is, I mean, you guys know about the Acris lag, right? So these are sales based numbers. So if something gets signed into contract in November, it might not close until January, in which case we're not going to show it until January. So a lot of these sales
correct.
might not
Correct.
be October, November, December. You could have some sales from August, September, even sort of in the mix. And again, you're still going to get those December closings. It's a bit of a lag. It's a bit of a messy way to look at it, but it's the way the industry looks at it. So it's helpful to kind of have that in mind.
Yeah, it's probably, the glass is probably like 65, 70% full. You know what I'm saying? Like it's not fully full. It'll be fully full in another month or so, month and a half, 2 months maybe. But it's not fully full. So, and also guys, when you look at this data, as John said, it's closed sales based. So you have to understand that the recovery that we have experienced in real time over the last few months that we've been talking about on UrbanDigs week after week, right, is likely not going to reflect in this sales report. That'll reflect in Q1 when all the deals signed in October, November, and December close in December, January, February, and March. Okay? Okay. Is there a question already, Johnny? I saw something
Yes.
blink.
God, you beat me to it yet again. Condos only, right? That's the first question. No. So these are
No, not
market
for
wide.
this. For this, don't worry, we got you covered on condos. We got another chart later on that's only resale condo. But for this is market wide because that's how the reports are done. So we're starting out with this table, then we'll get a little more granular. Hang with us, okay?
Yep.
Median sales price 1.1. What?
Another one. I mean,
Oh,
what can I tell you? With the luxury market doing so well in the fourth quarter, wouldn't the median sale price be higher?
like I told you guys, you can't. The Q4 activity shows in Q1. This is representing Q3. You guys have to understand space and time. You know what I'm saying? Q4 sales represents Q3 deals. So the Q4 deals and that recovery that we had in October, November, that will not show in this report. That will show in the next report. That's how this works, which is in
Yeah,
April. We get that report. Okay.
that's correct. And this does include resale and new development. They are mixed in. This is sort of this table here is a mixed look. And I just want to say these charts will be available. We'll download this and we'll put this up on the site so you guys can download it as well.
Okay. Very good questions because, we want to make sure you understand what's going on. So median sales price, by the way, for median sales price, guys, very volatile, but let's just go over it. 1.137. Again, we're showing quarterly change down 4.2%. Do not be shocked by that. You'll probably see a quarterly change up next quarter that represents the last 3 months of activity. Year over year is down 0.7. That's surprising since Q4 last year was so bad. But if I think about it in the same spatial and time element that I was talking about, Q4 last year represented Q3 in last year. So that's why the Q1 report in last year was what really reflected that fall, that bad fall. So it's all delayed by a quarter at least. Okay, we got to keep that in mind. Average sales price, average, much more exposed to those outliers, right? Median sales is probably more of a broader based metric. Average sales, more exposed to outliers, 2.058 million, up 1% quarterly, up 2% year over year. Yes, median and average will show varying different statistics all the time.
Yeah. And I just want to chime in a little bit about the median sales price, because we've talked a lot about in the last several weeks about how contract volume has really been increasing and the buyers are coming back regardless of what rates are doing. I mean, obviously mortgage rates ticked down. What that did is it allowed a lot of the more financing contingent, more finance sensitive buyers to come into the market. Typically that's under 2 million. So median sales price is really predicated on the numbers of sales that happen. So when you have more sales in that financing under 2 million bucket, it's going to bring down median sales price. It has nothing to do with the health of the market. It doesn't mean everything's cheaper. It just means we're having more sales in that bucket.
Yeah, good point, Johnny. Down to median price per square foot and average price per square foot. Again, this is a market-wide metric. We will go to resale condo in a little while. Median price per square foot is coming in just under 1,400. That's down 1.1% quarterly, down basically flat, down 0.1. That's just flat, flat from this time last year. Again, you will probably see the recovery in the Q1 report that gets released in April that we've all experienced. That's just how this lags work. Average price per square foot, 1,534, down 0.7 quarterly, down 3.3 year over year. So this is what you got as your basic set of stats. Now, let's go into all the different types of metrics and isolate Q4. Okay, isolate Q4, look at the activity in Q4 and compare it to Q4 of all previous years. 2015, I think this goes back to. So just so you guys know, like I got a whole bunch of charts now, the same format. We're looking at Q4 this year versus Q4 in the last 10 years, I think.
It's 11 technically because we included 2014, but yeah, we just want to
Okay.
have a nice decade look.
Okay. The current year is highlighted in orange. Okay. And John added this beautiful little vertical dotted line to show the 5-year average on the bottom axis where the values are. Okay. Bear with me. In terms of new listing volume, and John, you had to do a little estimation on this, right? You had to estimate the last couple of weeks because, we still got 2 weeks left. So John did a little estimation of this. 3,031 in terms of new listing activity. We're right smack dab in the middle. Okay, and we're below the 5-year average. So I mean, I think new listing inventory is just coming in generally light.
Yeah, that's a
Okay,
fair statement.
Look at 23 and 22, by the way. Look how they're below. So like, this has been like a constant kind of a thing. Okay, guys. I think we got somebody raising their hand. Let's go check this out. Hold on. Nikki, you are on the clock.
Hi. So basically, I was just wondering if you folks are planning on giving your thoughts or about what we might see in terms of inventory in the new year. If that's going to happen later in the presentation, then I shall withhold my question. But yes.
Nikki, I'll do it right now. I mean, personally, I don't think inventory is going to do anything crazy until spring. That's my personal feeling. I have a strange feeling the spring cycle might see more inventory for the first time in a while. Like, I think the sellers are going to come out of the woodwork. I could be completely wrong because I don't know where mortgage rates are going to be. I don't know if there's going to be a recession or a stock market thing going on, a macro thing. But
Right.
I have a strange feeling as uncertainty goes down and rates start to get into a tight channel, like meaning rates are not going to change much, right? I feel like people will make decisions.
Right. I think that does seem to kind of be where it's headed because I've been looking at the basically overall cost of ownership for like multiple quarters in a row, and it really actually hasn't moved that much, surprisingly.
Interesting.
Yeah,
Interesting.
and by overall cost, I mean like when you include both mortgage, as well as maintenance, and common charges and stuff. And
Yeah.
actually, and this has been something across categories in both Manhattan and Brooklyn. Like there were a few like outliers, every once in a while, but for the most part, it has shockingly stayed consistent over the last year, despite interest rates.
Interesting. John, any thoughts on Nikki's question?
Well, yeah. So I look at 2022, I look at 2023, how they're below 2024. So I get the sense. I mean, look, we're not the last half of the chart, right? 2024 all the way down to 2016. It's a very, very narrow gap between the biggest and the smallest, right? 2886 on the bottom, 3000 on the top. It's 120 listings versus if you go to the top of the chart, right? It's a gap of 800. So it's a much bigger gap on those. I don't think we're going to be in the top half in terms of, I don't think we're going to be seeing these big numbers in terms of the spring season, but I do think we're slowly increasing. So I'm hoping we're going to see an incremental increase in inventory especially to Noah's point that mortgage rates are starting to normalize a little bit. We're starting to get some of that downtrend working its way in. Maybe they've settled down. I think that's going to keep this sort of, we talked about this lock-in effect. I'm hoping this will kind of unlock some inventory. And remember, sellers are also buyers. So I think we're starting to get the market mechanics back moving again.
Yeah, really good question. Nikki, I did disable you. If you have more questions, please just raise your hand. Otherwise, I'm just going to keep going. But thank you guys very much. Questions are encouraged. Guys, let's just move this on. Let's see if I can get this thing right. There we go. Contract activity, right? Let's go. Supply, demand, right? Contract activity. Again, this is estimated. John put the little estimated thing over there. We're looking at Q4 deal activity. And, I think we closed out the year strong. Again, if you signed a contract in October, November, December, the chances that you're closed right now and filed with Acris and in there is very low, right? So this deal activity, this recovery is going to likely show in the Q1 report released in April, okay? But take a look at 2023 and 2022 and 2019. Remember 2019 for the longest time were like price actions at 2019, but those years very slow. And we seem to close out the year strong, John.
Yeah, we're closing out on a strong note. It's really neck and neck with 2020, which was interesting in its own way because that was very much a recovery year too, right? I mean, the market didn't open. I mean, it got off to a great start. Something happened. I guess we call it COVID these days. It happened from like March to July. We reopened, remember? And it took a while for the Manhattan markets to get going. They didn't really start firing on all cylinders until November, and then it was just gangbusters. So this is a market very similar, right? We started off kind of slow this year, a little bit of a little perk up in January, February, and then it's kind of lackluster. It's like, oh my gosh, this market is just, we're going to see another year of horrible slowness. And then it just kind of kept going through the summer, went sideways, and then really accelerated. So I think we're seeing very similar to 2020. Now, again, to your point, I did estimate this, so it is a bit of a rounding error. This could end up less than 2020, but we're right in that ballpark. And again, this really gets to the idea that we're in this sort of recovery phase. I'd actually say we're in the end game of the recovery phase. We're going to start to get hopefully a growth phase in the spring as we get more inventory coming in. We start getting this market really moving.
Yeah, guys, I hope you guys understand what we're trying to get you guys to understand here. I want you guys to understand where we are relative to like past point in time. And this is it tells a good picture, I think, as you go over through this and you kind of understand where supply is and demand is, and we'll get to price action and discount and all that stuff. But look at 2021. Look how crazy that was. Look at 2014 and 15. These were great years. Well, strong years, I should say. Not good for buyers, but they were strong years, very easy sell side climate. All right. So it's good to see this, and it really portends an interesting spring cycle. That's what this does. It really does. Okay.
Market pulse. Jump in quickly. Just a quick comment here. Nikki Beauchamp, we always appreciate Nikki Beauchamp. She writes in and says a lot of the end of 2020 activity was new dev signings that closed in 2021, and then she says that finding that buyers are wrapping their heads around where things really are and moving through uncertainty. Quicksand. So yes, I think you're right.
Yeah, I would agree with that. Hey, Nikki. Market pulse, guys. The market pulse basically looks at deal activity, looks at supply, it looks at both of those kind of things. This is the UrbanDigs market pulse, and we extrapolated that for the quarter. You guys could see where we came in again, right smack dab in the middle, considering how we started out 2024. Again, we ended quite strong to balance it out. Take a look at what's on the right side of this chart in the negative. You got 2020, 2019, 2022, 2023, 2018. I mean, all these years, guys, right? Like 17, 18, 19 before the pandemic was like the policy-driven slowdown. 22, 23 was just rate cut slowdown. So you can see where that is, and we're in a different place, guys. And look at the average. Look at the 5-year average. We're above it. So it portends an interesting, are we getting out of the volume trap? That's what this portends.
Right. And so we have a comment actually on the last chart that says, interesting that 2014 and 15 didn't seem as crazy busy as 2021 in the terms of the number of contracts, probably because inventory was so limited then. And I tend to agree. And if you fast forward to the market pulse, right? So market pulse is the relation between what's on the market and what's going into contract, right? And you can see that what's unique about 2024 is that it's positive, right? 2022, 2023, a lot of these really kind of years, negative. 2024, We're back positive. We're just over the line. We're nowhere near the crazy times of 2021, 14, 15. Those are peak times in which supply was so limited that demand was just golden. We're not quite there yet. But the fact that we're not negative, we're sort of just above the average, again, speaks to this recovering market. So the market's starting to finally find its ground here. And I think this is just another point in that direction.
Yeah, guys. Yeah, this is we're trying to get it in the head, right? This is all subconscious level market expertise, right? So that you guys could just ooze this kind of intelligence in your conversations with your clients, right? Listing climate, we like to keep it contextual. We like to give it contextual. Sorry, at UrbanDigs.
I thought you were going to go with cantankerous for a second.
I don't know where I was going with that one. Listing climate, guys. We're take a look at the green line, easy above. Look at the blue line, hard below. Right. We're trying to have very simple conversations on what's the temperature of that listing climate. Is it easy? Is it hard? Right. Where are we right now? So we're just above the hard level. The 5-year average, like again, it's been a rough 5 years. Like it's even before the pandemic, it was rough. We're just above that average, and I think the reason we're above that average is because of the improvement in the last 4 or 5 months. And if you look to the right, you see the same culprits, guys: 2017, 19, 20, 2018, 23, 22. And then you look to the left, you see the exact same culprits as doing good, right? You could see the years that was good and bad, but we're very much below the neutral line. Like if there's a middle line, I can't draw on this. I don't have my little John Madden pencil, but if this is the green line above and this is the blue line, the middle line's probably somewhere in the middle. We're still below that. So we're in the neutral / challenging listing environment. It's not an easy market at all. It's just a recovering market, John.
Right. But I think, one of the themes with this chart, with the pulse chart, with the contracts, with the listings, is this year's just falling square in the middle of so many markets. And I think, we on Macro Monday, we talk about the yield curve, and you've got the front end with, the overnight rate, then you got the long end, and there's that fulcrum right in the middle, the 10-year. So we're sort of fulcruming around this point. So this market at this point is really sort of a changing market. We're right at this fulcrum point. It's going from bad 2022, 23, shifting to better, and we're right in the middle on that journey right now.
Yeah, interesting. We got someone that would like to talk. It looks like we have, I don't know how to pronounce it. I hope I pronounced this correctly. Zin, but if I didn't pronounce that correctly, I'm sorry, but you are on the clock. Please unmute yourself and happy to hear what you have to say. You are muted. I don't know if you're talking. Let me see if I can ask you to unmute. Hello? Bueller. All right, we're going to disable talking. I guess we're going to have a rule here, right? You raise your hand, I'll let you talk. I guess we'll wait 5-10 seconds, and if nothing happens, we'll just disable and move on. I don't know what else to do. But we're here. Ask your questions, guys, and we will answer. Days on market, guys. Let's shift that. We're doing metrics. Okay, we know supply, we know demand, we know market pulse, we know listing climate. Okay. This is Q4 again, guys. This is Q4. We're not looking at the entire year. We're looking at just Q4, the last 3 months. Days on market. Now, Don, could you just clarify how you coded this? Is this for closings?
Days on market is the time it took to go into contract. So this is looking at everything that went into contract.
For closings that quarter?
No, for things that went into contract that quarter. So if you went into contract,
gotcha.
We're looking at how long it took you to go into contract. So you could fall out of contract, but you don't have to close to get into December.
So I want to just make a clarification here, guys. I love the way we do it here. All right. So if you signed a contract October, November, December, we look at how long it took, and that's this number. Okay. Most of the quarterly reports that get published by the major firms are probably not going to do it that way. They're probably going to look at the closings. Okay. They're going to look at what actually closed in Q4, and they're going to look at what that days on market is. We're looking at contract signed. I think contract signed is more real time to our market. That's why we do it that way. I just want to explain that. You may see differences. I want you to understand why. So we came in at 82, and again, kind of smack dab in the middle, right above that 5-year average. 5 years, last 5 years.
Surprise. Good. Right in the middle.
Right in the middle.
Someone was talking about that.
I know, seriously, stuck in the middle with you here. But I mean, there's not much to say here about days on market. I mean, 82 days. It's less than half a listing agreement. At least it's a transactional market. That's the most important thing. There is a market out there. That's the point.
Yeah. Just a note on housekeeping for days on market, we use from the first listing date that we have,
Okay,
not
good
the last
stuff.
one.
Any questions there, Johnny?
I just answered it.
That was the question. Okay,
That was a question.
very good. All right. Any more questions here? Unless we're going to move onwards. Price per square foot. That's like one of the bigger ones, right? We're looking at closings now. Now this is resale condo. This is where we're looking at just resale condo in Q4. If you guys recall, that table in the very beginning had market wide, right? So we looked at market wide up there. Now you're looking at just the resale condo market. Look at where we're coming in. This is why price action's not really going down. This is why a lot of people get confused when they have conversations with clients, like a seller bought in mid 2015 and like, how much is my place worth now? And naturally you go to like price per square foot. All right, well, where are we now? Where are we then? And prices are just, they're hanging high, John. They're not
Yeah,
surging,
no.
but they're just hanging on.
Well, to your example, right? 2015 was the price per square foot from sale day based on, what we've got here was 1414. It went down to 1300, 1297, 2020, then kind of came all the way back. So, you've seen some movement in price per square foot, just not really recently, right? So, in terms of, stacking these things up, right? The high hasn't really pushed forward. So, we're sort of at this kind of ceiling, haven't really punched through 1450 on the resale price per square foot yet. But I think the more interesting point to make, Noah, is we spent quite a bit of time in the last sort of set of charts talking about market mechanics, talking about how this market's recovering. We're seeing the volume come in, right? We're seeing days on market sort of right at that level. And we looked at listing discount. We're kind of like getting in there. But the whole idea is that the market has recovered in terms of deal volume, but it hasn't quite recovered yet in terms of price. Like it's up there, but it hasn't broken through yet. And I think that's an interesting point to make to potential buyers out there right now is that yes, the market's starting to come back, but when you looked at the stats at the very beginning, right, a lot of the year over year, quarter to quarter stats were showing negative still. So you've got this market that's clearly shifting into positive territory, but prices haven't quite caught up yet. So it's still early games in terms of this recovery, or rather growth sort of narrative that we're going to be talking about in the next several months.
Yeah, I got a couple points I want to say on price per square foot. Number one, it's kind of incredible that we have not gotten down more over the last 10 years. It's kind of incredible. Like you look at this, we're kind of up a little bit from 2015. It speaks volumes of this market. When you think about what we've been through since 2015, we talk about this, right? The SALT deduction got capped. The LLCs had a rule over there. The mansion tax came in. The rent regulations came in. The pandemic came in. The commercial sector got destroyed. Demographics shifted out. I mean, there was so many things that happened, right? You got the 90 local laws all over the place going on. And yet we're seeing these prints, these levels of prints. It's incredible that now, if you look at 10 years, we're like flat. It's incredible we're not down. That's point number one, right? It's a resilience thing. Number two, I think the reason why price per square foot is elevated over the last couple of quarters is because of the change in buy side mentality since the pandemic. I think buyers are looking at bigger stuff. They're looking at better stuff. They're looking at renovated stuff, more luxurious stuff, et cetera, et cetera. This is not new development, so that's excluded. So I'm not going to worry about that. But they're not buying small, unrenovated apartments. They're penalizing those. They're buying bigger, better, more luxurious. And if you think about the price per square foot of those, and if buyers are buying more of those, then naturally there's like this inflationary up effect. That's what I think is happening.
No. Well, I think that penalty is lessening, but someone writes in and they say, to what extent does this actual overall market value increase versus expensive listings being sold? And I think that's a great point, which is basically the luxury market has really kind of kept this market alive. And that, to your point, Noah, is exactly right. There's been that shift in taste and preferences, magnified, of course, by the fact that we've seen mortgage rates at highs, which basically says we're going to see more cash deals, right? So you're starting to get the market. Now, this number has nothing to do with how many units sold, right? This is just price per square foot. So if one unit sold at 1,400, price per square foot for the quarter would be 1,400. So it has nothing to do with the number of units sold. It's just a question of what that price is. And I think as you see more cash deals come in on the luxury side, renovated, et cetera, it's going to keep it a little bit higher than maybe it would have been had rates been lower, perhaps, given all of the sort of calamities that Noah talked about. A couple quick points. Is this just Manhattan data? Yes, right now, this is just Manhattan data. And next, can you estimate co-op price per square foot or per room? co-ops and price per square foot is a messy proposition.
You
So
email us. Maybe we'll see what it looks like and we'll send it over to you. Email John at
yeah,
UrbanDigs.com all day long.
both of those measures have their issues, right? So price per square foot is a notoriously wrong number when it comes to co-ops, and room is always very subjective. So we can do it. Of course, we have the data, but we don't think it's reliable, so we don't look at it.
Yeah. Luxury sector, man. The luxury sector, the mortgage rates, right? Mortgage rates have gone up. It's the luxury sector stepped up. That cash came out. Donna Olshan, we love Donna Olshan. She's like the queen of the luxury market. If you're out there listening, I don't think you're on this call. I want to have you on. Could somebody that knows Donna please tell her that we're begging to have her on here and do a luxury segment? I've asked her over and over again. All right. I need some help from you guys. Okay. We love you, Donna. All right.
Quick note, quick note. If we can go back. So basically, someone said writes in and says, so basically buyers are shying away from investing in something that needs work because rates are too high to take that risk.
No.
I don't know if it's a rate thing. I mean, no, you have some thoughts on that you want to share?
It's the inflation thing, right? It's the cost. It's what happened since the pandemic. Now that inflation has mostly come down, but the perception is still there. The perceived, I don't want to do it. I don't want to deal with it. So for example, let's say it's a $500,000 work job. Buyers are bidding down $700,000, $800,000, $1 million. They're like, I don't want to do it. I got to give me an incentive to do that. They're penalizing, right? There's an arbitrage play right now, for those of you that don't know what I'm talking about, in the estate condition rec marketplace in New York City. For those guys that can't trade those properties, there are people looking to flip because they got their own crews and they could do the job at $300 a square foot. And remember when $300 a square foot 6, 7 years ago was like a decent renovation? Now it's like 1,000. We just skipped 4, 5, 6, 7, 8, 900. We went right to 1,000, 1,500. I'm gonna go on my funny voice to go. Yeah, it's crazy. So there's guys like, I could do an amazing job for $250. I got my own crew. We're gonna flip it, and that's coming back in this market right now. I know for a fact because we've done some reports for those people.
Good point.
All right. Negotiability. Okay, listing discount, right? Asking price. They lower the price, then they negotiate. They get the bid, they close, right? The spread between that original asking price and that ultimate closing price, that is your negotiability listing discount. It's not from last ask, it's from original ask, okay? And you'll be shocked to hear this, but we are right smack dab in the middle. And it's amazing to me that this market went through 2022 and 2023, the volume trap years, the slow time, the Fed rate hikes, low volume. Last 3 months has been good, but that's just the last 3 months. We've been through that whole 2-year period, and we really did not see discount pop at all. Speaks volumes of this market. There's just not a lot of desperate sellers en masse in this market.
It's really remarkable. Again, given the fact that we saw early on, right, but some of the prices are a little bit weaker than they were, right? And to your point, Noah, that's sort of a time-based lag issue, but given the fact that the market was slow the first half of the year and is only catching up now, you would think that there may be some sellers who were trying to unload, maybe taking some hits to get there. But I mean, we're still coming in below the average. So it's again, another testament to the fact that this market is really recovered, had a nice recovery, and could shift to full-on growth mode in the spring.
Yeah, and it's good to know where negotiability is, between 4 and 5%, typically speaking. So that means half is probably above, half is probably below. Think about it that way, right? Now, Johnny, we're out of those whole vertical axis charts.
Well, I just want to clarify. So on the chart we just showed, that was so like days on market, listing discount. These are market wide, generally speaking. So if we have data for listing discount, we're going to use it. Doesn't matter if it's co-op or condo, because that doesn't necessarily affect days on market, doesn't necessarily affect listing discount. It was only price per square foot, that the chart we showed, that we actually specified resale condo because we try to keep it as apples to apples as possible. Other than that, these are generally speaking market-wide numbers.
Right. This is Q4, and again, this is looking at Market Pulse, but we wanted to give you guys a running look of how the market did this year versus last year in Q4 and the year before that, Q4. And you can see the black line is 2024. Again, you may or may not get value out of this chart, but I know there's some people that love this kind of stuff, and it gets to kind of show where we are. I mean, it's a stable move. Like it's just they're starting to get some stability back in this market, some recovery, some deal volume. It's not surging. It's like we went from slow to neutral. That's
And
the
that's
best
what I
way of
like.
explaining it.
That's what I like about it. So this is definitely a spaghetti chart. Most chart people would be like, "Oh my God, you got way too many lines on here," and they'd be right. But
Too many
if
notes.
we look
Too many notes.
exactly, but if you look at the 2024 line in black, it sort of starts low and just sort of goes up, kind of goes sideways, and then notice how we're starting to trend even slightly higher into the end of the year.
Yeah.
A little bit slow. That's a great sign to me. It's a sign that this market's not overheating. It's a sign that people are kind of coming back more or less in balance. I mean, obviously we could definitely use some listings, but that pulse ticking up, it's kind of a sign that the market is moving in the seller's direction for the first time in a long time. So if you've been on the market and you're sweating it, I mean, again, you got seasonality to contend with, but the market's kind of moving in your direction. So you might not have to be as aggressive, as desperate as you would have been 6 months ago to get a deal, because the buyers are slowly coming back in, and that's what this reflects.
It's kind of like 2016. It's kind of, if you look at that blue line right over here, it's kind of like, if it's weird. 2016 was that year after the peak, and we already started going down, and 2024 is after the move up. So it's kind of like 16 in the sense that it's coming out of the move, except 16 was coming out of an up move, and now we're coming out of a down move. So it's different directions. Interesting nonetheless. And I think we're getting down to the nitty gritty here, guys. Johnny whipped up this nice map visual showing you the main neighborhoods. And you could see the changes this is Q4, right? Year over year changes of supply and demand. Supply's on the left, demand's on the right. Look at the Upper East Side. Minus 15% supply, plus 12% demand. Like look at those kind of dynamics. Look at Upper West, minus 7% supply, plus, and this is like what's kind of going on is you're seeing supply tight, demand higher, and that's what's happening here. That's why the pulse of the market, the leverage, the sentiment is going a little bit more towards the neutral zone, John.
Yeah. So in not one of these markets is supply exceeding demand. So demand is exceeding it in all of the markets. I mean, Upper Manhattan is only eking up about 2% in demand, but supply dropped by 7%. Again, that's going to push the pulse up. We actually saw an increase in demand in downtown by 2%, but still demand is up 7%. So again, that also sort of pushes up the pulse. So we're starting to see the pulse rise on that borough level. You're starting to see it tick up. But if you break it down by neighborhood, each one of these suggests that the market is returning and is favoring sellers for the first time in quite a while here.
Yeah. And I don't know if we have any more. Yeah.
Let me just say, when I say
What?
favoring sellers, I don't mean that you can just throw something up 20% over the last sale.
No.
Yep, I'm going to grab it. No, this is still an extremely price sensitive market. You're going to be penalized if you overprice. Like you just, the market's moving, but you got to be priced at the market. And that gets me to one of the comments here. We got a few comments. Oh, I don't want to interrupt everyone, but it says, would you recommend taking a listing off the market for the holidays, or would you let it sit?
It's such a tough question because I figured the holidays would be slow, and they're a little bit stronger than they usually are right now. But it's still, a neutral / hard listing climate. Like we've recovered from a challenging climate to like a neutral / challenging climate. It's not easy. Like it's not easy out there. So, if you're 3 months on the market right now, if you're 3 months on the market and you did not get a deal with the recovery that we had over the last 3 months, you may want to take it off the market and refresh in spring. You may want to do that. If you're brand new on the market right now and you're just catching it, if you're 2 weeks, 3 weeks in, I would just suggest do your typical price reduction and see if this market will come back to you a little bit. I wouldn't rush off the market just yet. I would give it a good 90 days just to let the market speak. But the first 30 days tells you everything about your price.
Yeah.
Tough. It's tough.
It's a very idiosyncratic thing. And I think I would be looking at specifics regarding my listing, neighborhood, even building if you want, if you've got a lot of competition, kind of judge and see how it is. Again, and we didn't really put this in, but one of the charts that we love to think about is discount to days on market. And the amazing thing about that chart is you can go back. I don't know if you want to pull that up on the site, but you can go back in time and you can see that things that are priced right, which means it's going to trade in less than 30 days. It's not really affected by market dynamics, which is to say the market could be horrible, but if something's priced right, it's going to move in 30 days or less. So,
what you're looking
There you
at right
go.
here. Let me show you what you're looking at. You're looking at, first off, you're looking at this category, which is Q4. Okay, so that's the current quarter. And what you're looking at is closings that took less than 30 days. Look how that spiked up to 2% actually. But that is representing Q3 deals. You got to keep that in mind. The point here is if you sold quick in Q4, you had to negotiate 2%. If you sold in over 120 days, you had to negotiate 10%. So there's a relationship between how long it takes to get a deal and what that listing discount overall median is.
Yeah. And it's amazing how consistent that spread is. Good market, bad market, right? Even
Yeah.
in a good market, your penalty is going to come down to maybe under 10%. In a bad market, it's going to go up to 15%. But the reward in a good market, you might actually see above ask. You might see the median down at like -1, -2%, meaning most people are getting over the ask. But in a bad market, that under 30-day discount could be 5% or 4%, 3%. Like it's not bad. It's like a normal sort of thing. And it's sold in less than 30 days, close to the asking price kind of thing. So very, very dependent on the market. Essentially is, it doesn't matter what the market is. It's really predicated on getting that listing price right out of the gate, which is why I think sentiment, understanding market sentiment, which we've been trying to sort of explain here, is so crucial.
Yeah. All right, well, let me just put this back up here so you guys can see it. I mean, I don't have anything else to say. I just wanted to show you guys all these charts. I wanted to give you guys an understanding of where we are. How is the quarter unfolding? What do you need to know? I know there's a lot of information here, but I think we went over the main talking points. If you have buyers right now, it's getting a little bit tough for those buyers. It's getting a little bit tough for those buyers. Like you got to
It's
look.
going to be a really tricky spring for buyers.
Yeah, you got to look. You got to focus on what's not selling for those buyers, because there's not much new listings coming on the market. Obviously, they're going to look at new listings. That's going to happen no matter what. But you got to look at those things that are on 4+ months on the market and having price cuts.
So I feel really bad for the people who've been shopping for a home for several months. They haven't found anything, and they're hoping that maybe when spring comes, they're going to get something fresh on. But
yeah,
I think they're going to be overwhelmed by in a wave of competition, buy side competition. They're going to be going to an open house instead of being one of 3. They might be one of 5, one of 6, one of 10 even. I mean, we could start seeing crowds at open houses again, which I like to see. I think it's a healthy thing for the market. Let me shift back. We got some comments. Do we have a chart showing average dollar maintenance per square foot? We do. No. It's a very bespoke thing. It's not on the site.
Not on the site.
If you email me, I can see if I can dig that up. But it goes by listing, so it's not the most.
That's John, JOHN at UrbanDigs.com.
At UrbanDigs. Thank you. I like you got close to the mic for that one.
Send it to him.
Noah, when does spring start for listing purposes in your estimation?
Okay, so I'll tell you exactly how we figured that out. We're in the chart room right now. We go to monthly new supply is typically the chart that you're going to use to figure this answer out. And you could do this locally, but I'm just going to do Manhattan wide. What you want to do is go 1 year, click on 1 year. So because if you do 5 years, it gets a little kind of erratic. That shows the seasonality of the market. 1 year, and you want to take out the blue and only show your average. Okay? So this is telling me what the monthly new listing averages are for each month of the calendar year because I got 1 year. So I could see that January starts at December 607. So it's low, right? January's 1316, but that's back end loaded. That's most of that comes in the last 2 weeks of January, not the first 2 weeks of January. So you're not going to start to see an uptick until about the 3rd week of January. And then that uptick will slightly continue in February because it doesn't really, still the winter, okay? It really gets going in March, April, and May. That's where the listings come in. Okay? That's how you figure that out. If you want to see how we're doing compared to that, you can overlay the actual production over the average and see if there's more stuff coming on or less stuff coming on versus the average. Okay.
Okay.
Anything else, John?
Quick question about the renovated versus unrenovated. We updated that a few weeks ago, I think. Somewhat.
Yeah, I don't have it though. I have it in Canva, and I don't want to go look through 75 charts right now and find it.
Yeah, we've got it. If you feel free to email me if that's something you want.
JOHN at UrbanDigs.com.
So the story with that chart that we're not showing you, so you have to just imagine this in your mind's eye, is it looks at a rolling 1 year set of data because it's really difficult to kind of find these things and isolate them. And if you just look at like quarterly numbers or monthly numbers, it's just all over the place. So we try to just take a lot of fuzz out and just sort of do 1 year. So I think we updated it I think a few weeks ago. We've got it. So just email me if you want a copy of that. What about casinos in New York City?
What about them? When we going?
I'm not a gambling man, so I'm not going to go.
Are there any?
Well, I guess that's the question. What if we have bring casinos to New York City? How would that help? I mean, I think anything coming to the city helps. I think anything that makes this city more of a destination is good for the market, unless that's a bad, unless it's like a landfill. Like that's not the kind of destination you want to have in your
Bring
city,
back
right?
the old 42nd Street.
Right.
Oh, wait.
No, I don't think people want that. But I mean, look at Hudson Yards. Hudson Yards came out of nowhere and it's awesome. It's a really cool place. It's a thriving neighborhood. Like the High Line, these kind of things. These are just
Chelsea,
really
yeah.
amazing urban redevelopments, but they're not the old style redevelopments where like, we're just going to knock these things down and make these people move and build something cool. No, they just kind of like took old stuff, redesigned it. It's a really fascinating thing. I hope we could do more of it. I mean, there's so many places in the city that could use like fresh look. Like I look at the East River above, say, like 96th Street. It's just it's ripe for someone to come in and reimagine it.
This infuriates me and frustrates me beyond belief, because if we just had the will, the motivational will, and to change some policies, you guys would see a completely different market for years in a good way. But I don't think we're there. So it is what it is until it changes. We have someone that would like to talk. Adam, I'm going to allow you to talk really quick. You are on the clock. I don't know if you're still there, and I think you're muted. Adam, you there? Hello, Adam.
Hey, Noah, can you hear me?
Yes, there you are. How you doing, Adam?
Fabulous. Good. How are you, sir?
I'm doing well, thank you.
Thanks.
What's going on?
This is great. I had a quick question for you guys. I love the optimal time to list chart. And I was curious if there's any way to sort of correlate that with like average days on market to determine like an optimal time to launch, as opposed to, I take the optimal time to list thing as like, this is the best time to be on the market. You know what I mean?
Yeah. So this looks at so this looks at deal activity by month for the optimal time to list, and basically telling you the highest contract activity months that this market tends to have across the calendar year. And you can see our seasonality here of March, April, May, June. October, November is a little less. Interesting. So I guess the way we would calculate that is we would look at deal activity by month and look at days on market and do an average of all of them historically and see if we can get any clues. You know, I like that idea, Adam, a lot. I'm going to ask Johnny to make a mental note somewhere, write it down somewhere, and we'll do a Fries Day on it and see if we can report on it.
Cool. That's awesome.
Yeah,
Thanks, guys.
One of the things
Thanks, Adam.
we talk, I've talked about this chart sort of in-person updates. And one of the things I like to talk about is the fact that the orange bar optimal time list, that's when you want to have your listing live. So you need to prep it so you're on the market in that time. If you want to do spring, you might as well do March, which means you might as well be on the 1st of March to kind of catch it, or if you be on late February. So the idea
or late
sort of,
February. Yeah.
Right. Kind of prep it. But I like the way you're saying. I like a little bit more. Hey, I mean, is there another use for numbers? Sign me up.
Can we make more charts? You know, the way I look at this, Adam, is this is your spring season right there. So coming on the market, right around there or right around there is kind of prime. The idea is that if you fail at your initial listing price, you could take action and still have 30, 60, potentially 90 days to have the market react to your new price, versus if you're in October or November and then you cut your price, now you have to deal with December and January with a price in a slower market. That's the whole idea of the launch optimal time.
But look, you stick with us, you get a price right the first time, all good.
Any other questions? Thank you, Adam. I appreciate that. Cheers. Any other questions, John?
All right. I don't see any questions here. We're
awesome. We made it through.
Someone says happy holidays. Thank you, guys. Bruce Robertson says that. Thank you, Bruce Robertson. Happy holidays.
We love Bruce Robertson. We love a lot of you guys. We see a lot of these names sound familiar. Thank you guys so much. You guys have made an amazing year. Thank you. I hope you guys like what we're doing with UrbanDigs, the changes that we're doing, with the direction that we're going. Couldn't do it without John Walkup. John, thank you for being an amazing partner, business partner, and co-host of all these shows. I couldn't imagine doing it with anything else. It warms my heart to have you guys here. I love doing this job. And from what I understand, you guys like what we're doing too. So my promise to you is that we will continue to rock on in 2025 and beyond. And you guys let us know what we can do to be better and we will listen. Okay. Until then, thank you, Johnny Walkup. I'm Noah Rosenblatt. This has been your end of quarter update, and we will catch you guys next time. Happy holidays and good luck.
Happy
Everybody.
holidays, everybody.
Cheers.